first of all, before we get into the problem, any questions? Let me just add that in this quadrant, we need 461H, okay, economic performance, right? And it's not good enough just to prove reliability. Any questions about our four-part quadrant? Raphael?
I can't see what you wrote in the
461H.
461.
Yeah, economic performance. Right? So let's go through page 704. We have lawyer, render services to client which are deductible to client under 162. Lawyer sends client a bill for $1,000 on December 24th, year 1, and client pays the bill on January 5th, year 2. Discuss both the tax consequences for the lawyer and client, assuming even if it is unlikely, they're both calendar year accrual method taxpayers. Okay? So, bear in mind they're both accrual method taxpayers. We have lawyer, we have client, and again, let's just make it clean here. The client is going to look for deduction. Lawyer is going to look for inclusion. And lawyer sends a bill for $1,000 on December 24th, and client pays it on January 5th. When does the client get a deduction? When does the client get or secure a deduction in this case? John? Jesse?
I think year 1.
Jesse, you agree or disagree? Agree with your authority? 461H, right? Economic performance was rendered. Year 1. When does lawyer have income? Felicia, Annetta.
Let's see, year 1.
Year 1? Felicia, agree or disagree?
I agree. Yes, it was.
Yeah, you earn the money. Even though you didn't get paid until year 2, doesn't matter, right? Do not become Jerry Maguire. Do not follow the cash. Okay? We're good? Very simple depiction of the accrual method taxpayer. Question 2. So that's question 1. Lender lends out money, legal rate to debtor. Debtor is required to pay $5,000 of interest each year on the loan, which extends over a 5-year period. The interest is deductible by debtor under 163. The agreement calls for payment of each year's interest on December 31st of the year. The loan is made on January 1st of year 1. Both parties are calendar year accrual method taxpayers. So look familiar from our prior problem, right? And we're agree, very familiar. But this time we're dealing with accrual method taxpayers, right? Mike's looking for a deduction, or I should have it different. I should have debtors. I apologize. Lender and debtor. On December 31st of year 1, debtors having quote-unquote serious financial problems fails to pay lender. When does debtor get a deduction? Diane Costello, when do you get a deduction? So when do you get a deduction? Diane, year 1 or year 2? Costello, agree? And who's right, Anna?
I'm thinking year 1 because that's where part of the agreement.
The money's been out there, right, Buster? You said economic performance. The debt is owed, right? And we know with certainty what the amount is, right? So it would be year one. What does the lender have to include in that, David?
This one?
What, say again?
For the lender, it's year two.
Year two, David, agree or disagree?
I agree.
Why?
I'm not sure.
Luca?
Why?
Or what year would you include it? Wes?
It's year two.
That year,
I'm flip-flopping.
you're flip-flopping.
Yeah.
This is Spring City, got included in year one. Doesn't matter about the financial issues. You've earned it, baby. We're good? Question B. On December 31st of year one, debtor does not pay the interest because of a legitimate dispute over debtor's obligation to pay the first year's interest. So in this case, Tina, year one, year two, you get a deduction, and Larry C, you agree with Tina. You sure, Larry?
So we were talking about deduction, right?
I am talking about deduction.
I don't think the deduction could be made in year one because there is a dispute.
There's a dispute, right? The all events test isn't even met here, right? There's no deduction. No deduction, right? It says he doesn't owe it. Karina, do you think you have income? Or does the lender have income? No, that's because, right, if you look at the regulations under 451, there's no right to receive it, right? So no and no. There's actually a revenue ruling 70-151, and there's a revenue ruling 57-463 for supporting each of those propositions. Question C. On December 15th of year one, debtor legitimately disputes the obligation to pay year one interest, but debtor does pay it, and in year two sues to recover it. Okay, so everyone had the visual? Debtor says, you know what, I really don't owe you this money, but I'm going to pay you anyway. And then he sues it to recover it. What year can debtor, Ashley, Jesse, get a deduction?
I would say year one.
Jesse, would that be right?
I agree.
Ashley, what's your authority? Anyone have authority? Edward, you have authority?
161H2. Economic one.
Jeff, you have something up your sleeve? See, you have no sleeves. I guess you know. 461F. Let's look at it together. Contested liability. The taxpayer contests an asserted liability. Taxpayer transfers money or other property to provide for the satisfaction of the asserted liability. The contest with respect to the asserted liability exists after the time of the transfer, and but for the fact that the asserted liability is contested, a deduction would be allowed for the taxable year of the transfer, determined after the application of subsection B, and deductions shall be allowed for the taxable year of the transfer. So here, guys, in question C, the answer is year one for the deduction. Code section 461F, right? We need all four conditions here. How about as to inclusion here? How about as to inclusion? Nick, Joanne?
Year one.
Year one,
Why?
you received the money.
Received money.
Yeah, North American Oil received the money. Okay, suppose debtor pays year one interest on January 2nd of year two. Debtor, when do you get the deduction and how much? Lewis? And Raphael, when do you get the deduction?
I want to say year two, but I'm not sure.
Raphael?
I'm not sure, but
James, you say what?
Year one?
Why, James?
It was, was it intended for year one? He just paid it in year two.
So what do you say year one? Economic performance, right? Doesn't matter what the money trail says, right? He owed the money, and there was economic performance, right? When do you have to include it? To here, Louise?
year one?
You agree, Louise? Say loudly, year two. And do you agree or disagree?
I said year one.
Zach, who's right?
It's year one.
It's year one, Louise. It's an accrual method. They earn the money, right? They have to accrue it in income. Do not follow the cash. Right? And I'm telling you, for the exam, you'd be wise to circle cash or accrual, inclusion or deduction. Know where you are on the map, quadrant. Question E. Debtor pays all 5 years worth of interest, $25,000 to lender on December 31st of year one. Okay? So debtor here. Johanny, Ji Ying, when do you get a deduction? Johanny, what do you say?
Year one.
Okay, year one of how much? Say again, say it loudly.
I'm not sure if for a pool of this environment.
Ji Ying,
I'll say 5,000.
5,000. And John, is your hand up? Or Nick?
5,000 capitalized interest.
Yeah, you can only deduct 5,000, you gotta capitalize the rest. Inclusion. Jackie, what do you say?
To include all of it.
Include it all? Karen agreed, disagree.
I agree, include it all.
Include it all, right, Mike? 25,000, put it in there. Claim it right. Again, notice, right, the asymmetry here, right? The asymmetry. Wes?
Can you explain why would they include all 25?
Old card cash, North American Oil.
Because they receive cash.
So they received all the money.
Receive cash and they can do as they please with it, right?
So what will happen in year 2, 3, 4, 5 for the lender?
What?
So lender reported $25,000.
Yeah, and then doesn't have to report when they subsequently receive the cash. I mean, they won't receive any more cash. I apologize. So they're done.
So let's say that they keep doing their deductions, whatever
Fine,
expenses.
fine. Say again, there's
The
nothing to do with
expenses are-
deductions.
Well, for the lender side, the case for the matching principal or what I.
There's no matching here. Remember, there's asymmetry.
But that is cash.
So, well, let's say I have inventory. And then
But let's stick with these facts. I don't want to get. Yeah.
So we don't have to worry about that matching principal.
There is no matching here. You'll see if the problem addresses what I think you're raising, the next problem, so hold your thought. I think it's going to address your problem. All right, so the answer here everyone has. All right, question F. Debtor pays the first 2 years interest to lender on December 31st of year 1. How much can the debtor deduct? How much can the debtor deduct in year 1 in this case? Again, I do this, Katie, Dave, what do you guys say? How much can you deduct in year 1?
I'm trying, my book is different, so I'm just finding what it is. First years and
Yeah, different edition. Dave, do you have the newer edition or not?
He does.
I would be in the
Okay.
Jesse, do you have the newer edition?
Yes.
So when does debtor get to deduct? And how much?
5,000.
I'm sorry?
5,000.
In what year?
Year 1.
David?
Isn't this the exact same question we just answered, just a different number?
Well, you tell me.
Yes, this is the exact same question.
Well, so hold on. So how much are we going to deduct in year 1?
You can deduct 5,000.
All right, let's deduct 5,000 in year 1. Now, life is a little different. How much do we have to include? Now, I know what you're thinking, David. No? North American Oil, right? Include 10,000. However,
Well, it was a big trick all along.
big trick. Remember that we're dealing with an accrual method, right? And we're dealing with deduction issue. Hold on, excuse me. We're dealing with inclusion issue, right?
Yes.
And, right, we're dealing with an inclusion issue. And if you remember where that revenue procedure says that if it's over a 2-year period, right, even if you get all the cash in 1 year, you can accrue it over 2. But that revenue procedure said it doesn't apply to interest and prepaid rent. So you might say, gee, doesn't apply here. But, as they call to your attention, there's that mortgage guarantee case that's immediately following the revenue procedure, which the taxpayer was, under mortgage guarantee, allowed to accrue it over the 2-year time period. So they could, because this is over only 2 years, right? Under mortgage guarantee, the case that immediately follows this revenue procedure, accrued over 2 years.
The taxpayer makes that election?
There's no election physically, they would just include it half in year 1, half in year 2.
Okay, so
That's mortgage guarantee. If you want a page number, I'll give it to you. The case of mortgage guarantee is page 689 of the text. Page 689. All right, Joanne, John?
2 years, you included both years, more than 2 years, you included year 1.
Right. At least that's the position of the IRS, John. Now, here's question 3, which is going to challenge you, Joanne. Okay? Everyone have question 3? So, questions 1 and 2, just try to illustrate general principles. Question 3. You have a crew. I love these taxpayers' names. Calendar year accrual method taxpayer runs the dance school, which offers lessons over 48 months. Last I checked, guys, 48 months is 4 years. Okay, we're good. With 1 lesson each month. No makeup lessons are offered, nor is the 48-month period extended for a participant who misses scheduled classes. Scratch your chins. Sounds like art now, right? Baseball games, but instead of being over 2 years, now it's over 4 years, right? It's a little bit beyond, right? Even the double raise case. Agreed? Agreed? The cost of the lesson is $480 or $10 per lesson, which is required to be paid in January of the first year. Based on prior experience, the crew has found that each lesson, including salaries, rent, and utilities, costs about $4 per person. On January 1st of year one, 100 students, good for them, sign up and pay for the lessons which commence in January of year one. Right?
And the school went out of business.
Well, we don't know that. So we have year one, year two, year three, and year four. And we can look at this. Two different ways. There's a somewhat, I'll call it famous poem, famous song for both sides now, Judy Collins. So we can look at it from both sides. The taxpayer side and the IRS side, okay? There's two different, very different ways of looking at this, guys.
How
Okay?
many lines do we need?
Say again, Ashley?
How many lines do you think we need between the taxpayer and the IRS? I want to mess up my whole notes.
Well, we're going to have the taxpayer position here, and it's only going to go down 3 lines. And
Okay.
this one will go down 3 lines, so I hope your notes can accommodate to that, okay? And we will call this the taxpayer side. We call this the IRS. And the taxpayer says, you know, akin to our, now we know when these dance lessons are going to be held. We're dealing with inclusion issues, right? The taxpayer says, how much do the taxpayer really earn each year, guys? 12,000, right? 100 students, right? And each month they're paying $10 or $120 each times $120 times 100 or $12,000 a year, right? So the taxpayer says, I really should be able to take $12,000 per year. And what were my expenses? What were my expenses? Well, we're told $4 per month times 12 is $48, right, per student. Times 100 students or 4,800. And you would argue, hey, I can handle this, 7,200. Now, is this the position the IRS has, guys? No. What does the IRS say? What would you think the IRS would say here?
You can take the money and put it to the bank. and earn it.
Yeah, so how much should you include year one?
Well, 70, I mean, close enough.
No. All of it, which is how much? 48,000, right? You got paid 48,000, include it all. And you had expenses in the first year, 4,800. That's 43,200. And each of the subsequent years, no income. And you just experienced losses for the next several years. Ashley, I hope this still worked for your notes.
Working.
I'm okay? And I think, John, this is somewhat, I think, what you're alluding to over a multi-year period. I think, but maybe I'm wrong.
It is, it just defeats the purpose of GAAP completely.
Yes, it does. But GAAP and tax sometimes intersect, sometimes they don't. Two very different agendas. Okay? Now, sorry, David, about your notes, because you're two. What's the right answer here? It's not clear. All right? Remember, we have case law that has gone beyond revenue procedures where the IRS acts like the Pope and says, I give my blessing to this outcome, right? And the IRS has said in certain circumstances, we'll give a blessing to a particular outcome year, or whatever. Here, it's not clear, and the authors are obviously pushing the limits, saying, that's what makes tax interesting, because today, the Tampa Day Devil Rays, the taxpayer prevails, you have stare decisis, and you could use that case in that circumstance, perhaps, where it goes out 3 years. Here, we're going out 4 years, uncharted territory. So it's not clear who would prevail here. And again, keep in mind, these dance lessons happen with real specificity, right? Change the facts, and there's no, the dance lessons were arbitrary whenever the client showed up, and they could have all taken the dance lessons all in year one and not over 4 years. Very different outcomes. You were going to say?
I have a question. If that would be the case for tax purposes, will the taxpayer be able to carry back the losses from year two?
Yeah, Code Section 172 deals with net operating losses, probably could carry them back. But remember, they can only carry back 2 years carried forward 20 years. So this is Donald Trump, right? You think of Donald Trump? David?
I have a question, so I'm going to step back. You open, these cases are governed by case law. You open the song and dance school, you do the more advantageous one on the top, and it goes to trial, and they say, yep, that's cool, 70, what was it? 700 a year.
7,200.
Seriously? Oh, 600 a year. So I see your success, I open the Decker School, do the same thing, it goes to court again, and they say, oh, that's no good, it should be 43,200. So I now have to pay all these back taxes. Is there also a fine involved, or can I?
You can pay it. I mean, I think in that case there's Code Section 6662 that deals with penalties. And I think you would have what's called substantial authority, that's the benchmark, to say no penalty should apply in that context. So I think the only way, by the way, if the tax court rules in my favor, the tax court would have to rule in your favor, but if we live in different circuits, the Third Circuit, which is New Jersey, might approve my way, but if you live in New York, which is the Second Circuit, may not approve your way. So you run the risk of it in the appeals process that different outcomes might come about, and then that if there's different circuit courts having different opinions, that usually spells out a case that at some point the Supreme Court may grant a right of writ of certiorari. That's usually what happens.
667 kind of has if I put a good faith effort in.
Yeah, it's not good faith. It's called substantial authorities. That is the criteria to get avoid penalties under Code Section 6662. All right? Not good faith. It's not benchmark. All right, so the answer to your question for you guys, there is no clear answer. I mean, that's what makes tax truly interesting and exciting. If there were just answers, the good news is you can't just ask Siri what would be the answer, right? You would have to tell the client the pros and the cons, and that's what we call job security, because you would be there to tell the client how to consider this and what are the risks and what are the potential penalties. If there's really clear, crisp answers, guys, again, our days are numbered, truly, right? So, thankfully, there's no clear answers, right, David?
Tell me which cases are in quadrant 3 and 4 over there?
I don't know. I don't have. You mean?
Bottom left, bottom right.
I mean, just go through our case book, and you'll fill in the blanks of what's relevant. I mean, some of our cases, guys, just affirms general principles. Okay. All right. Question 4. Question 4 is a good one. Why is it good? Because it mixes it up, which is never a bad thing. Widget Corporation, accrual method taxpayer orders $3,000 for the carpet cleaner from Mr. Carpet Cleaner, a cash basis taxpayer. Notice, that can happen, right? One taxpayer can be cash method, one can be an accrual method. On November 1st of year 1, Widget receives and pays for the carpet cleaning on April 1st of year 2. Assume both Widget and Mr. Carpet Cleaner are calendar year taxpayers. So I'm going to try to keep my mouth shut, but take 2 minutes and figure out the year of inclusion and the year of deduction here for Widget and carpet cleaner. Okay? And I just call your attention, I'll reach into my other pocket. With Mr. Carpet Cleaner, you may want to have 2 different labels. He's cash, so put cash at the top, and we're dealing with inclusion. And Widget Maker is accrual method, put that at top, and we're dealing with deduction, okay? So I would have different labels. Cash or accrual, deduction or inclusion. So tell me year 1, year 2. Look at this problem, come up with your own answer, 30 seconds. All right, Trina, Larry, what do you have income? You're a carpet cleaner.
I said year 1.
Larry, agree or disagree?
The cleaner is cash basis, so I guess the income recognized in year 2 when the company received the money. So it's
And
year-
Tina, we have a difference of opinion. Who's right?
I have year 2 inclusion.
For inclusion? Right, Trina, that's when he gets the cash, so it's gotta be year 2. Right? He physically gets it in year 2. Luke, Zach, when do you get a deduction?
Year 2?
Zach?
I agree, year 2.
You say Zach. Yeah, Zach, year 2, right?
Yeah.
All right, economic performance. Agreed? Agreed. Okay, let's change it up. Same as A, except that Widget pays $3,000 to Mr. Carpet Cleaner on December 1st, but of year 1, but expects the carpet cleaning to be done on April 1st, April Fool's Day of year 2. When does Mr. Carpet Cleaner, Raphael, Lewis, when does he have income?
Year 1?
Year 1? Lewis? Raphael? You agree?
Yes.
Yeah. Gets the cash. James, Jeff, when do you get to deduct?
Year 2?
James, agreed?
Yeah, year 2.
Year 2, right? Economic performance.
I think I agree.
Version C. Same as A, except that the carpet cleaning occurs on December 1st of year 1. So we're back to problem A. Carpet cleaning occurs on December 1st of year 1. So, cash method taxpayer. Nick, Jessica, when do you have income?
When it's paid.
So what year 1 or year 2?
Year 2.
Nick?
But it's paid on year 2,
It is.
so I would say year 2.
Year 2. When do you accrue deduction here? Mike, Wes?
It would be year 2.
Mike? Nikisha, you had an opinion?
Year 1. That's when the service.
Year 1. Economic performance, year 1. Question D. Same as A above, except that you learned that Widget had sales of 2 million and expenses of 1.5 million. So this is chunk change, right? The carpet cleaning in year 1, and typically orders $3,000 for the carpet cleaning every 10 months. So we're back to problem A. Jessica, Nick, when your carpet cleaner, when do you have income?
When you receive it.
Well, what year is that? Year 1 or year 2?
That was year 2.
All right, that's easy, right? Everyone agree? Year 2, right? How about Mr. Carpet Cleaner here? In this case, Alicia, Aneta?
Year 1.
Alicia?
Yes, I agree with one because there was exception within small and it occurs regularly.
Okay, so this might qualify under code section 461H3, right? The recurring item. Let's look at that together. Everyone have it open, 461H3? In general, notwithstanding paragraph 1, an item shall be considered as incurred during the taxable year if the all events test with respect to such item is met, right? Economic performance for such item occurs within the shorter of a reasonable period after the close of the taxable year, for 8.5 months after the close of the taxable year. So it's got to be one or the other. Okay? And where does the economic, here it's occurring in April, which is certainly within the 8.5 months. Such item is reoccurring in nature, and the taxpayer consistently treats items of such kind as incurred in the taxable year in which the requirements of clause I are met. So it's reoccurring in nature, which we're told it is. And for little I, such item is not material. So we've met all 4 of these conditions, and therefore we should be able to accrue a deduction in year 1. Okay? In year 1. Why? Because he's going to be treated de facto as a cash method taxpayer. Right? All he has to do is meet the all events test here. So it's year 1. In contrast, and in problem E, the one difference is, first of all, I know that Nick and Jessica would tell me is their carpet cleaners year 2 when they receive the cash. But the difference in problem E versus problem D is the payment is October 1st, and last I checked my calendar, that's outside the 8.5 month time frame, right? So therefore, we're stuck where we're once again, we've got to meet the economic performance test, which we don't, so we're stuck with year 2. All right, everyone good? You can see it's challenging, but if you're patient and you label things correctly, guys, I promise you, you will get to the promised land. Okay, you will. Of the correct answer. All right, final segment. Final segment. You ready? What was that, Ashley?
I thought the syllabus only said page 705. Like a great holiday present would say, farewell, this is so much to study for.
No, I gotta give you guys an extra tuition dollars for it, so this is a bonus surprise.
That's the income.
An extra.
Code section 61 at work. All right, forced method of accounting, okay? Because taxpayers play games, okay? We know that the code, in this class and other classes, you will see there's opportunities for collusion. When those opportunities for collusion exist, Congress sets up impediments. And we've seen some of those impediments, like sales between related parties. Code section 267 disallows sales between related parties. Husband and wife, 1041, treats it as a non-event. The code, that's a small smattering. There's lots of code sections that deal with those issues. All right. So code section 267A2, if you want to keep it open, code section 267A2. Yes, you will. Pay attention, pay attention. You'll see, this is good exercise. Code section 267A2 says, if, by reason of the method of accounting, the person to whom payment is to be made, the amount thereof is not includable in gross income, so for some reason the person who's receiving it doesn't have to include it, and they're related, at the close of the tax year, the person for which, but for this paragraph, the amount would have been deductible, both the taxpayer and the person to whom the payment is to be made are persons specified in the paragraphs as subsection B, then any deduction allowable under this chapter in respect to such amount shall be allowable as of the day as of which such amount is includable in the gross income of the person to whom the payment is made. So in other words, you don't get a deduction until your related party has income. I'll repeat. There will be no inclusion. Now let me rephrase that. There will be no deduction until the related party takes whatever the money is into income. So if there's a related party, you can't get an upfront deduction while the other person gets to defer inclusion. And if your head is spinning and thinking, what the heck does he mean by that? Okay, fair. That's a fair. It's easier to see by way of illustration. Okay, so and this will make your night. Do not worry for exam purposes. Just look at code section 467 that deals with so-called rent holidays. Just know that it exists, but don't look for really any exam questions on 267. I care much more about section 267A2, okay? 267A2. So let's look at problem 1. Let's look at problem 1 in this concept of math. In each of the following situations, to determine in what year the payer would be allowed a deduction and what year would the payee include the amount in gross income. Okay. A, the accrual method taxpayer ordered and received $500 worth of janitorial supplies in year 1 from B, who is unrelated, notice the word unrelated to A, and who is cash method. The supplies are used in A's cleaning business. A makes the $500 payment to B sometime in year 2. So we have A, and we have B. And A is looking for a deduction. B has inclusion issues, right? And A is an accrual method taxpayer. And B is a cash method taxpayer. So, Evelina? And then I don't know if I heard this from you last time. When do you have inclusion? year 2. Payment is received in year 2. Agreed? When you have Luca and Edward, when do you have to accrue it into income?
Year 1.
I mean, accrued deduction, I apologize.
Year 1.
Year 1, Edward, agree or disagree? Year 1, right? Economic performance. So just, these are unrelated parties. Everyone notice that someone's getting a deduction in year 1. Meanwhile, the other taxpayer doesn't have to include it in year 2, right? But, heck, that's life, they're unrelated. But it's not an ideal outcome for Congress, but Congress has to live with it. Notice in question B, same as in A, except holy cow, A and B are father and daughter. Okay? Are they related? How do you know they're related? I know it seems obvious, but look at code section 267B. 267B says members of a family are related. No one's falling off your chair. And if you look at 267C4, who is in the family? Now, some people around Thanksgiving had family members, but they also probably under the code, CJ, you could have raised and said over Thanksgiving, who's a family member under 267 around C4? You get to serve first. C4 says brothers, sisters, spouse, ancestors, lineal descendants. All right? Everyone see that? So here your daughter would be. So they are related parties. How does that change the outcome in question B?
Well, A can only deduct in year 2 because B can only include the income in year 2.
Right, it's because inclusion is not happening until year 2, right, Tadia? That since this is not happening until year 2, you can only take a deduction in year 2. That's what code section 267A2, this is the example. This is right on point, right? Louise, you got that? You see what's going on here? Congress is saying, look, if you're related, we don't like these shenanigans. No one can get an upfront, an upfront deduction, and the other person doesn't have to include it. It's too much in the way of games. So if the other person gets to defer income, the deduction is going to be deferred in the case of related parties. Right? Everyone got that? Yeah.
What would happen if they were like the opposite? Like one was a cash.
Funny you asked that. Look at the next question. What results?
Guess I didn't read the problem.
I guess not, but I'll leave it at that. If A uses the cash method of accounting and B uses the accrual method, Nick. Okay, think of it, just 30 seconds of silence. Each of you come up with which year. We're changing the fact pattern. When B has inclusion, A has deduction. If one is they reverse. So if now B is an accrual method taxpayer, in this case, Mike, Wes, when do you have to, sure, Jessica?
For year 1, they received the supplies, I guess, in year one.
Yeah, the supplies were made in year one, right? Given in year one. So, in terms of inclusion, right? Accrual, inclusion, he earned it, right? So it would be year one. When would A get a deduction if he's a cash method taxpayer? When did he pay? He paid in year two, right? So to answer your question, Nick, if you reverse it, the forced method of accounting does not, right, Katia, come into play because Congress has no problem with this outcome. Deferral of the deduction and immediate inclusion. This is tax heaven for Congress. Right? So the forced method of accounting only comes into being in the reverse. All right?
Sorry, can you repeat that?
All right?
Why is it not, year one deductible?
Because
They're
our
related.
to take their money right up front.
He didn't pay, right? He didn't pay until year two, right? Trying factually. So just correct me if I'm wrong, the fact that he's a cash method taxpayer, right?
Yeah, but I thought
And Congress
I thought if
doesn't.
they were related, you can.
It doesn't matter in this case. That only comes into being if one person gets an immediate deduction and the other person doesn't have to include it until another year. The opposite is not true. Congress has no problem with someone having to put off a deduction but has immediate inclusion. So Johanny, again, no symmetry here. Congress has no problem with this outcome. It's pro-revenue. Everyone good? Last question, question two. Let's do A, B, and C here. I think we'll give it taste, sufficient taste, because I'm not going to get too complicated for exam purposes. What the purpose of question B is designed to do is to see who's related, okay? And look, members of a family, pretty easy. Everyone agree? Everyone can know, who's a sibling, who's not, and things like that. All right. But it's not as simple as that. In question 2A, it says X corporation is a accrual method taxpayer, leases a parcel of land from B, a cash method taxpayer. B owns 60 out of the 100 shares of X. Are the two related? And if you say yes, what's your authority?
I have to read the code section, the fact that he owns more than 40% of, or he controls more than 40 to 60% of the property.
But you would want a code section because we all want a code section. And we would turn to code section 267. B2, look at it. An individual and a corporation more than 50% in value are deemed related, right, Nick? So
Yeah.
more than 50%, these would be related parties. And as a result, we have the potential application of code section 267A2. Yeah.
This is the same thing that we kind of talked about for section 1239, right? Like kind of
Right.
a similar provision.
1239 deals with the recharacterization of income. Again, code, when you guys pay corporate tax, code section 318 has what are known as a lot of attribution rules. Question B. Question 2B. Question, same as A, except that B owns 40 shares of X. S, B's spouse owns 15 shares, and the remaining shares are owned by unrelated parties. So, are these related parties? And here, just point out that is B deemed to own the shares of his spouse? And the answer is yes. What's my authority? Code section 267, C2. C2. Question 2C. Same as A above, except that B owns 20 shares of X. S, B spouse owns 15 shares of X. And B and Z partnership own 40 shares of X. The remaining shares are owned by unrelated parties. B and Z are unrelated parties. Each have a 50% interest in the capital profits of the B and Z partnership. So, do you think you're deemed to own the shares of your partnership? Would that make sense? So, let me just make an observation. And then we'll call it a night. We have B owns 20 shares on his own, right? He's deemed to own, BS, his spouse's shares, another 15 shares, right? What's my authority? Code section 267C2. And finally, BP partnership, he's deemed to own how many shares? 10. So he's deemed to own ultimately 45 shares total. But where's my authority for owning the partnership shares? Look at 267C1. 267C1. It says, say again, Ashley?
BB partnership, wouldn't it be, doesn't he own?
No, 20, the partnership owns 20 shares, he owns,
The partnership owns 40 shares.
oh, it owns 40 shares, thank you.
Right.
Owns 40 shares, okay, that's 40 shares. So he would be deemed to own 1/2, or 55 shares. And my authority here is code section 267C1. 267C1, let's look at it. Stock owned directly or indirectly by or for a corporation, partnership, estate, or trust shall be considered owned proportionally by its shareholders, partners, or beneficiaries. All right, so in the aggregate, he's deemed to own 55 shares. All right, and this would make him a related party. All right, give me 2 more minutes, then we'll call it a night.